I'm Douglas Mason, CEO of Naturally Splendid, symbol NSP on the TSX Venture Exchange. Naturally Splendid is a biotechnology and consumer products company focused on the global cannabis and health markets. Naturally Splendid is expanding distribution in this rapidly growing market with products currently in Canada, the USA, South Korea, Germany, and Australia. To view our comprehensive company presentation and for more information, please visit our website at naturallysplendid.com.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Eric Hadik, CEO and President of InsideTrack.com and InsideTrackTrading.com. Welcome back to the show, Eric.
Oh, thanks for having me back, Jim.
Eric, on your long-term charts, did you foresee the bumpy ride we're seeing with the markets right now?
Well, I've been talking about October and some of the unique characteristics of that month, but not just of that month, but on a very specific basis. And it's this 2-year cycle. I did a series of articles back in September about it, kind of prepping my readers for it, and the conclusion was that we should see an 8 to 10% drop in the first 2 weeks of October and a 10 to 15% drop over the month of October. And it was in sync with just an uncanny 2-year cycle throughout this bull market. So since the 2009 low, in 2010, 2012, 2014, 2016, you've seen a lot of very similar action. In fact, I think we were even talking about it in our 1 or 2 interviews ago. And even throughout the entire year, you saw similar patterns where on each of those 2-year basis, the equity markets would start out the year with a fairly significant sell-off. And in each case, they bottomed within the same 10 to 12 day period. I think it was February 5th to the 16th. And so that happened in 2014. That happened in 2016. And then again this year, same thing. Sharp sell-off, bottomed right in that time frame. Then it starts to steadily make its way back towards the high. And that's kind of the next trigger in that sequence, that when those markets finally make it back up to the preceding high, they would spike above them for maybe a week or two and then see a decent sell-off. And then going out farther through the year each time, and not just on that 2-year basis, but also in 2011 and 2013. So it turned out to be, I think it was 6 of the last 10 years, as well as this 2-year sequence. There would be a pretty sharp sell-off between mid-September and mid to late October. And so all these things were coming together, and this year, the 2 trigger sequences aligned together. The first one being that the Dow finally got back up to its pre-February drop high, or back to its late January high. And it did that in late September, and at the same time, it was entering the time frame when every 2 years you saw a significant sell-off, and there were several monthly and weekly cycles that I had diagrammed. And then my intermediate work triggered a 1 to 4 week sell signal in the NASDAQ 100 at the end of September and the first couple days of October. So it lined up very nicely. And then as we started the decline, I kept my readers focused on a couple of key things. And one was a weekly trend indicator that I thought would finally be triggered during this decline. And that would do 2 things. It would confirm that this was a larger degree peak than, say, what we saw back in January. And that means that you should expect another sell-off down the road a little bit after an intervening bounce. But that signal also usually times the end of the first decline, and it was triggered on October 26th, and the next day was the bottom in this sell-off. So the market has really kind of adhered to these technical and cyclical and analogous patterns, and it's the synergy of all those things that really had me giving the bear warnings in late September, early October. And I think that the damage that was done, like I said, shows that it was a higher magnitude peak, and that's already giving some important clues about what to expect in the coming months.
And clues for the coming months, what are they telling us?
Well, the one thing that I said was we got an initial low in late October. We would see a rebound in November, but then I'm looking for actually another series of multi-week declines. The first one, I'm looking right now that we should probably expect the next intermediate low just before mid-December, which means you've got a sell-off going into that period. The magnitude of that is going to be determined by the action in the next several days. But then I think you could see, like I said, a series of some sell-offs. And for me, that kind of leads into my longer-term outlook that was calling for a series of 3 important peaks in 2018 and a sharp sell-off in October, and then a bigger sell-off sometime around the middle part of 2019. So there still are corroborating factors that I need to see to reinforce that outlook, but what we've seen the last 2 months has given some powerful initial confirmation to that scenario.
The last couple of years, we've seen rough Januaries and Februaries for the stock markets. Is that going to be the case, or is that going to be delayed?
That could certainly set up there, although when you do see, and I think that's one of these things too, why something like a 2-year cycle has more impact. People often will look back at the previous year, and so that, as they're coming into 2019, they'd be looking at that late January to early February sell-off and thinking, oh, can we have something like that? And often the market will start to do something that looks like that, and you'll get people jumping in saying, oh, this will probably be, an 8 to 10% drop like we saw last January, and then all of a sudden the market just turns and rallies to new highs or does the unexpected. And so that pattern could certainly be delayed, like you're saying. The way some of my weekly cycles are shaping up, it probably would be different than that this time around. So I don't expect to see that similar of a pattern repeat that quickly.
Is this going to be what I call a step-down correction, not a big crash where it happens over a day or two, but this is going to be a long-term thing, but you wake up a year or two later and you realize your portfolio is down 40-50%?
I'm not sure of the magnitude of it, but I do agree with the pattern you're describing. Now, often with those patterns, at the culmination, you do see the sharpest sell-off. And, even when you look at something like the Dow, not the NASDAQ, but if you look at the Dow and some of the other indexes in 2000, 2001, and right into early 2002, there were some series of decent sell-offs, and then the market would rally back, maybe 75% of what it had lost. And so it looked like the bull market was reestablishing itself. Now, during the same time, the dot-com bubble was exploding or imploding, and the NASDAQ was just getting crushed. But some of those others, stocks were more deceiving, and you had the one sharp sell-off surrounding and leading into 9/11, although that sell-off had really been going on for a couple months prior to that in 2001. But even that, there was a pretty good recovery from in indexes like the Dow, and then it was leading into that 2002 low where you saw another downdraft. And that's the general pattern that I think you could see, and I think that's kind of what you're talking about too, where it's very deceptive. You get a sell-off like we just saw in October, and everyone says, okay, that's a good correction. Some of the indexes went into bear market territory, but then they came out of it, and some of the stocks did that. And you get the bulls starting to say, okay, it's time for a new leg up. And the market gives you some of that, enough to deceive you and lure you back in, and then kind of rolls over again, and then rolls over again, and it is similar to what you're describing. I would agree with that.
We'll have more with Eric Hadik right after this.
I'm Greg Johnston, CEO of Carl Data Solutions, an industrial Internet of Things company that provides big data solutions for monitoring critical infrastructure. Carl Data offers machine learning and predictive analytics features through our cloud-based applications to deliver key asset-saving operational insights from massive amounts of data. Carl Data trades on the CSE, symbol CRL, and the pink symbol CDTAF. For more details on Carl Data, please visit carlsolutions.com.
Media recognition from Bloomberg, Reuters, recycling trade publications. Patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
Welcome back. We're chatting with Eric Hadik. Eric, crude oil is down quite a bit from its high just a few weeks ago, it seems. What kind of pattern do you see setting up for crude?
I think that crude put in a 6 to 12 month peak, and that was in sync with multi-year and multi-month cycles that I've discussed since third quarter of 2017, that all my work was showing a bull market from third quarter 2017 into third quarter 2018, and it dovetailed with Middle East cycles that I did a series of articles on, where that late September of 2017 into late September 2018 was just for me a momentous long-term, or the culmination of a momentous long-term cycle, and I thought that we would see rising tensions in the Middle East and at the same time rising crude prices, and they pretty much culminated or entered a crescendo at the same time, and you kind of had a double whammy there in late September, early October, and flowing through to the present, where you had the much anticipated renewing of Iran sanctions. Of course, what people weren't anticipating leading into that was that immediately after there would be waivers given out to numerous European countries, and kind of nullifying at least the oil impact of what was being expected. But it was also interesting to me that crude oil peaked within about 24 hours of the Khashoggi execution, killing, whatever they're calling it now, which, the event itself is, in many situations might be a blip on the radar, but what it means for Turkey-Saudi Arabia relations, and what it's meaning for the power of the Crown Prince of Saudi Arabia, those ramifications are probably going to be playing out for the next year or so. And it was interesting to me that was almost in perfect lockstep with the top end crude. But all in all, it's just a fulfillment of these longer term cycles. and we've now seen crude and unleaded gas drop all the way back to their early 2018 lows, and look like they're going to find some support right there, but it's what I call an inverted V pattern, where you start out a year with setting some lows in a market, then you rally into at least mid-year. Sometimes it extends beyond that, but before the end of the year, you're crashing right back down to the original lows and sometimes breaking below them, and it just shows this broader reversal going on in that market, and that's what you've seen in crude and unleaded gas. Like I said, I think they're running into some pretty key support. They'll probably find a bottom there for a while, but some of my indicators are saying that we should see another downdraft after an intervening rebound.
How do your war cycles and the price of crude match up right now?
Well, when I talk about the much broader long-term war cycles, which have talked about 2021 as being the next phase of this 40-year and particularly 80-year cycle that has timed either culminations or the onset of major wars in America, and even going back before America's founding in Europe, back to the early 1300s, you've just got this consistent 80-year cycle, and 2021 is it's the exact phase of that 80-year cycle. But when you're talking about something that long-term, naturally you need to give it a little bit of latitude. But I think that, like so many things, it's not going to be until you get close to that you really see the escalation or intensification of whatever conflict is brewing. And so same thing with the price of oil, that, I think that it set a major multi-year low in early 2016. And so everything we're seeing is a developing uptrend, even a sharp decline like we've seen lately, but that you don't see the parabolic part of that uptrend until very near the end of the cycle. And so as we're getting into something like those war cycles, if there are, and I think you would see corroborating events leading into it. I don't think it's going to just come out of the blue. But if you see those reinforcing events taking hold, you'll probably see oil, and that's assuming that it's impacting something around the Middle East or something around oil. But you'll see that reacting. But that's not something that long term is not something that I'm looking to trade day to day, week to week, even month to month or year to year off of. It's more just a backdrop for some of the geopolitical expectations that I'm building.
We'll have more with Eric Hadik right after the break.
Cypress Development Corp's flagship lithium project is located just east of Albemarle's Silver Peak mine in the heart of Clayton Valley, Nevada. A 12-hole exploration drill program for lithium-enriched claystone on Cypress's 100% controlled properties is now underway. Cypress Development Corp trades on the TSX Venture Exchange, symbol CYP, the Pink CYDVF, and on Frankfurt C1Z1. For more information, please visit our website, cypressdevelopmentcorp.com.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're speaking with Eric Hadik. Eric, what do you see happening with gold?
Gold, I think, is going to stay in a fairly wide trading range. Much of that trading range set by the action of 2016, that 6 or 7 month rally we saw from late 2015 into mid 2016. That to me was the A wave of a corrective rally. And what I mean by that is you have your decline from 2011 into 2015, which broke down into a pretty clear 5-wave pattern that has certain implications. Even though I don't trade off something like Elliott wave, there are certain characteristics that I think are very clear cut in it and that can really benefit an overall developing a perspective on the markets. And so after having that clear 5-wave decline, you will often have a corrective rally that is what they would call an ABC. So you get your A wave rally, which took hold in 2016. You get your B wave decline, which can often correct a majority, 70% or more, of the initial advance, because it is more of a corrective pattern. And so we've now seen that, and I think that a B wave low is taking hold, and then you expect to see a C wave rally, which is often comparable to the magnitude of the first rally. So the advance that we saw in 2016 wouldn't surprise me to see a similar magnitude advance in gold over the next 6 to 12 months. But I think that that's going to be in stages and more of trading range market. But all part of that overall pattern.
Eric, thank you so much for chatting with us.
Thanks for having me back, Jim.
My guest has been Eric Hadik, CEO and President of InsideTrack.com and InsideTrackTrading.com. If you have any questions for Eric or any of our other guests, you can send them to info@HowStreet.com. Find us on Twitter @HowStreet. Our popular YouTube channel is Talk Digital Network. I'm Jim Goddard. Thanks for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.